Well, we are live, so
wow.
I want to take this opportunity to thank everybody for joining us, and most importantly, to thank Olin Douglas from Motley Fool's Venture for joining us. The purpose of this conversation, as many of you know, 1863 Ventures has created a series of articles, webinars, and tools that we'll be rolling out for the next several weeks, hopefully not months, to help businesses operate in these challenging times. So, Olin, I want to thank you so much for taking time to join us.
Thank you very much, Melissa, for inviting me. Happy to be here and happy to help in whatever way I can.
Well, we are, as we were talking before we officially started, 1863 represents a diverse set of businesses across the country, and many of them obviously have been engaged in fundraising activities. A smaller subset already has capital. So my hope for this conversation is to hear what you're telling your portfolio companies, but also kind of giving advice as we have folks that clearly now have to respond and think about, how does this look? Because my revenues are changing, and how do I operationalize this if I've had to let people go? And then also, how do I even continue, or do I need to look for alternatives in terms of financing? So I'm going to just for the group, I'm going to ask Olin some questions, and we'll just kind of keep it informal. And then definitely want to encourage people. We'd prefer that you use the chat, but there's also a Q&A function, and I'll be checking both of those. But it'd be ideal only because that everybody can see the questions. And my sense is that most people may have a similar set of questions, and we can just capture them all. So just assuming that, everybody doesn't know exactly what Motley Fool Venture is, but we all certainly know Motley Fool, and I do from back in the day where they would actually literally wear the hats, the gesture hats. Talk to us a little bit about Motley Fool Ventures and how it got started, because you do have a unique model with respect to LPs.
Yes, sure. Thanks, Melissa. Really glad to be here. Motley Fool Ventures is a subsidiary of the Motley Fool, the parent company. We launched a venture fund a couple of years ago in 2018 with the idea that we had come up as a venture-backed company. Today the Motley Fool, the parent company, is 99% owned by current and former employees. So we raised a bunch of venture capital and went through a whole process of basically buying our ownership stakes back from the VCs. And along the way that we had lots of experiences of things that showed us how VC could be done right, how it could be done differently, let's say.
I like that, yes.
And it really encouraged us to say, if we're going to go into this, we're going to do this different from the ground up. Everyone talks about being founder friendly kind of venture capital, but we think that we can add another emphasis on top of that and really do it well. And that started from how we designed the fund. What Melissa was talking about is your typical venture fund gets their money from investors who they call LPs. The idea is to get a small number of institutions to write large checks. They invest, you tell them what they're going to do, you set them aside, and you do your business. And the Motley Fool being community focused, we decided to turn that model upside down. Instead of getting big checks from a small number of people, why don't we see if we can get relatively smaller checks from a lot of people and turn that into a community that we actually use to not only help us find deals, but to help us support the entrepreneurs when they're in our portfolio and vet other ones. So turning that model around, what resulted was, instead of having your 10 to 30 LPs that your typical venture fund has, we have around 800 LPs, and they're in 45.
That's a lot of personalities there.
It is, and that's one of the things that's interesting, though, is all of our LPs were either subscribers to the Motley Fool or were invited by as subscribers. So while it's a lot of people, what you're getting that's supporting the venture fund is a unified philosophy. And so our 800 can move forward with certainty and conviction and a certain amount of positive energy that I know flows all the way from the beginning to all the way through the end. I know that there are VCs that have maybe 20 LPs, but those LPs don't know anything about each other. And that's where you get all the voices. I mean, the voice you're going to hear from the Motley Fool, which flows to the Motley Fool Ventures, which flows to the LPs, is we want to invest in great founders. We want to invest for the long term. We want to have sound businesses. And so those kind of philosophy, it flows through in a way that makes it Actually, I've been talking to people. I actually do think it's been easier for me to manage
Hmm.
my 800 than some other people who have just a handful.
I'm
Yeah.
sure. I'm sure. Because if they all have a unified mind, then you can say something once as opposed to 5 different ways to Sunday.
Yes.
Before we dig in to kind of what you've been advising your portfolio companies, give us a sense of who is in your portfolio, kind of what stage, what kind of companies. I've had the privilege to meet a few, but let help folks understand who gets investment from Motley.
Right. So the companies that get investment for us are largely in the Series A range. They're companies with $500,000 and trailing relevant revenues, which typically works out to like $1 million ARR. This is a kind of a general idea. They're what we call tech-enabled companies, which means companies that are using technology to deliver scale, efficiency, and access into existing industries. So we definitely look for companies that are using technology as an enabling tool to really expand and sometimes even disrupt those industries. I would say our check size is it's a $150 million fund. Our initial check size typically runs between $500,000 to $2 million, and we can put up to $15 million into a company. So we intentionally come in with the idea that we want to build a relationship and support our portfolio company over multiple rounds. And we come in really looking for situations where we can add value beyond the capital. If all you want is money from someone, maybe if you're doing really great, we'll just give you some money, but that's not that's not what gets me out of bed in the morning. I mean, what gets me out of bed in the morning, honestly, a lot of it is what's happening right now, where our founders are, many of them going through downturns for the first time, and they're not quite sure what to do. And I don't want to date myself, but the first kind of downturn I went through was the 1987 S&L crisis when I was an auditor auditing S&Ls during the crisis.
I was working for Treasury, so I'm like, you all have no idea what's out there.
Right, and so and with the food through there, I think we've picked up some tips and tricks, and I talked to Melissa about sharing something that we have already shared with our portfolio companies that we surveyed for them to tell us what they were seeing. And it's really just this idea of making sure people don't feel like they're alone and that they don't have to figure out everything from scratch. I mean, I'll get ahead of us. One of the least efficient things that you can do right now is try to reinvent the wheel. There's so many people who have experienced downturns before that it really is smart and easy. And that doesn't really come together that often. It's the smartest thing and the easiest thing to do right now is just ask for help. And I'll take it.
So it's interesting because before we get to the suggestions, I want to make sure that people understand, just for their own purposes now and later, the uniqueness of what you do. And so you said something where it's not just about the money. So just talk about some of the non-financial supports that you all provide, because my hope from this is that people who are in other portfolios can take some suggestions back and, to your point, ask for help, because we know that some folks are scrambling, and particularly for entrepreneurs of color, if we're on the first round, we know that in some cases investors are kind of doubling up on the later round folks. And so we want to make sure that they can advocate for themselves. So share a little bit of the non-financial stuff that Motley Fool does, irrespective of this crisis, that helps entrepreneurs.
So we have, like even outside of the crisis, when we invest, we do things, we assess the culture of a company before we invest. I mean, that's something that's very important to us. We're looking for, we don't have a diversity mandate in our portfolio, but that's largely because I like strongly believe that diversity and inclusion is an asset and it shouldn't have to be mandated. It's just smart business. But we assess the company's culture before we go in, and as regardless of where they are, as long as we can believe that they have a commitment to improving that, that's something that we'll work with them with. And we have lots of resources internally through an entrepreneur in residence that used to be a former portfolio company CEO pre-exit. That's now with us in the entrepreneur residence program. We do have access to some resources at the Motley Fool, but we bring people in for 1 day or a few hour seminars, other things to help them. My background, I was a CFO for the Motley Fool for the majority of my career, about 14 years. Lots of background in financing, raising capital, probably raised, during the fund and all things, it was probably close to $500 million of capital of my career from all different types, so lots of experience there. We're just there. Pretty much any operational challenge a company has,
Okay.
we can help them with it. Don't ask me to program anything. I can't code. I can't code anything.
Anything except coding at this point.
Yeah,
Gotcha.
I can't build anything. I can't do that, but I can rock a spreadsheet like nobody's business, you know.
That is music to my ears as a finance person. I love it. I love it. But I think that's helpful for people to know, because I do think my hope is the first takeaway is that you in who you are, but Motley Fool in and of itself is very different, and that you do not have the spray and pray mentality, but is really a holistic investment of cash and non-financial tools to focus on helping the business grow and scale. That is my big takeaway for what Motley Fool is.
Yes, and our North Star from one of our co-founders who had to kind of approve opening the fund is make our portfolio reflect our best vision for our future. So, and just a quick story on that is we looked back and said, let's pretend that we're actually going to be good as a VC. We actually do well. And we invest in these companies and they all become significant world-changing companies. Are we going to sit back and say, what have we done? You know, when we look at what we invested in, a lot of people find themselves in that position. And we just said to ourselves, we're actually going to ask ourselves that question up front. Like, what are you doing? And so we don't have to worry about what we have done. So we're looking for companies where if what they do is adopted globally, we are excited and proud and honored to have supported that effort. And we still have financial targets, but we also are taking that firm position. We are going to do good and do well. We believe we can do both. And so that narrows the companies a little bit. But if you're not aspiring to do good and do well, it's going to be a little bit more challenging to get in our portfolio.
Gotcha. So now that we understand what you do and the fact that you're already unique in that, because I think there are a lot of venture firms going, oh my God, what did we just do? So kudos to you, because again, we do know some of the companies. What are you saying to them, right? My mom is 92 and she's like, y'all don't know, you're soft. I lived through World War II and the Great Depression, like y'all are soft. And even to your point, right, living through SNL and then even the debacle of the banks, there was, I would say, a different level of information and understanding of how to stop the madness. We seem to lack that. So I'm wondering if you could say what you're telling your portfolio companies right now.
So the primary message we're delivering to our portfolio companies right now is to assess where you are and I'm not sure why my video is dropping off, but
we're taking a look at it behind the scenes, so stand by.
I'll keep clicking back on. I'm going to keep talking, and if it drops off, I'm clicking it back on. Is to assess where you are and kind of make plans for how you get through it. And we're having conversations with our portfolio companies when they need it, step by step. Here's what you do. Here's how you do it, to make sure that they understand what's going on. But the main thing we do, and you'll see some of this in our presentation, is make sure they have the current environment in context. The market has definitely dropped a lot. We make sure that they understand what's the connection between the public markets and the private markets. And for you guys, just a couple little stats for you to understand. In 2019, and this is according to a source called PitchBook, and which many of you are familiar with, 25% of all VC deals had a corporate VC in it. And when you look at the dollars, they account for half of the dollars. So from a funding perspective, corporate America is a big part of that. We all want to get the big Fortune 500 corporate client as a client, right? So we're all pushing for that. They, on the other hand, are continually outsourcing their R&D to startups. And so there's an operational relationship. And as we all know in Dream, and Melissa, I know you know this, every conference sponsored by corporation, right? And so they're big, big supporters of the ecosystem at every level. And so what you see in the stock market doesn't directly and immediately affect startups, but when it affects the the benefactors, if you will, it will come down to this area. So if it hasn't hit you yet, that doesn't mean it's not going to hit you. And that's part of what we work with our portfolio companies do, is to really look through what I call like the startup supply chain. Let's just think about all the things that are happening, not just what you see right in front of you, but behind you and behind you and behind you.
Yep.
And for example, I had one portfolio company that came back and said, our project was froze. The corporate of big company froze all the budgets. And there wasn't a discussion about which one. But he said, but what we're doing is perfect for what they need right now. And being on that side, and what you have to understand as a startup is things that are crazy out there are crazy in these corporations as well. And for me as a CFO, if I was in that spot, I would do the same thing. I just need everything to stop moving for a second. I can't make any special exceptions. I can't make any. I have to stop everything so I can assess where I am. And that same advice is one of the advice I would give to the startups. You got to take an account and an inventory of where you are right now. If I said, Melissa, give me directions to New York, her first question would probably be, well, where are you right now? Because what I give you depends on where you are.
Right.
So,
That's a great analogy.
Yeah. If you don't know where you are, someone is not going to be able to give you good advice on where you want to go or where to get to go. So that pause to figure out where you are is really, really important. And then it's about just kind of figuring out what are those critical milestones that you need to be aware of? And it's scenario planning. If this happens, I'll do that. If this happens, I'll do that. And usually I encourage them to pick extremes. So that you end up kind of painting the edges, if you will. And once you paint the edges, you'll learn what the levers are. And then you can decide when and how to take the steps that you need to take to get through this.
Yep. So I wanted to summarize. So you talked a little bit about where you are right now and really getting a handle, because already being an entrepreneur, there's tons of moving pieces. And you're right, you can't focus if they're all still, moving around. What was Kevin Hart in night school? Like all the numbers just kind of jumbled and pop up the page. But also this scenario planning, which we've talked about, but you've added an additional layer of scenario planning and extremes, because I've been watching the press conferences every day, and then I've tuned into a town hall last night, and some folks have us getting better when it gets warm. Some folks have us getting better in 2021. And there's a lot in between there. So that's extremely helpful. I'm curious, in the typical venture capital cycle, we make investments and then we keep a little bit on the side because we know we're going to have to reinvest. Has your strategy around ongoing financing for companies changed? Do you think that there's going to be more money that you're going to have to deploy, and just trying to understand the financial and non-financial support that you're kind of gearing up for your portfolio companies?
Yeah, and that's a great question, Melissa. And we just had this conversation that I've given to our team to kind of distribute to our portfolio companies. Is we're a young fund, so we've allocated maybe a third of the money we have. So we have plenty of access to capital. It's really important for people to understand that capacity and willingness are two different things. It's like just because people have money doesn't mean they're willing to allocate that. One of the things I know, if I put my VC hat firmly on, I know I'm going to have an extra degree of scrutiny around any investment I make during this period. Right now is not the time where I'm going to take a flyer on something that is on the edges of my investment thesis and probably much more speculative. If anything, I may break my thesis to invest in something bigger that has a surer possibility of success, right? VCs are not immune to kind of the emotional pressures on them, and nobody likes uncertainty. Nobody likes investing in uncertain times. So for us, again, we're going back to that plan. We're asking all of our companies, put together the plan of where you are. Give me a scenario for, let's say if this thing lasts a few months, give me a scenario where you need to be positioned to go through the rest of the year without raising capital. and then let's have a conversation about those plans. And between those scenarios are things where, well, would additional amount of capital help you here, help you there? But yeah, I'll stop there.
So it's interesting because I do think you've raised something where I think we intellectually know, right, that as an entrepreneur, venture capitalists have lots of stakeholders as well, but the primary relationship is, could you give me some money? And entrepreneurs are constantly thinking about investors and lenders and customers and suppliers. So I'm curious, as I think about your big stakeholder, which is the 800 LPs, have you heard from them? Have you checked in from them? Are they nervous? Because the nature of Motley Fool is kind of managing the markets, right? Motley Fool was started around this educating and engaging people in the capital markets, probably the most unstable I've seen them in a long time. So what are they feeling as LPs, and how are you responding and kind of calibrating your advice to entrepreneurs versus what their concerns are?
Yeah, that's great. So we have a strong competitive advantage being associated with the Motley Fool. They have the public market dynamic. When they blanketed like we've never had before. Just 2 days ago, we did a 24-hour nonstop understanding of volatility video webinar. And so every hour, a new host came in to talk. And we have offices around the globe. So it kept going. At the end of the day, I think the last I heard, the only 2 that we didn't have filled was there's a midnight slot and a 3 a.m. slot.
Somebody needs to nap at some point, yes.
Yeah, but otherwise, so around the clock, providing different context and perspective from around the globe about how this is going. We send out communications.
Gotcha.
Often, but one of the things I would say is communication is really, really important now. And by communication, I don't mean answers. I just mean where you are, right? I don't expect anybody to have answers now. Probably more than ever, more than any other time. People are not going to expect you to have the answer, but they need to know where you are so they can help. So because of what the Motley Fool is doing to address the market's been so great, we've been able to be very targeted in our conversations to LPs. We sent them one notice early March about understanding volatility in bull markets and bear markets, just so they could keep things in context. And the takeaway from that is, if you are a long-term investor, this too shall pass, right? And if it doesn't, nobody cares about your investment portfolio.
Right, we got bigger issues.
Exactly, right? And then the second communication was, this is exactly what we're doing with our portfolio companies, so that you know that even though we have a long-term perspective, we're not just sitting back doing nothing.
Gotcha.
Waiting for things. Our third communication was a communication to founders, who we probably will focus on for the next couple of communications. One for them, we did a survey of them and got their results, and then shared those survey results with everyone else with some context from us to make sure that everyone is getting good information flow back and forth. One of the things we learned was it's difficult on a founder who may be going through this for the first time to also have to deal with 10, 15, 20 independent questions from investors. And, well, how you doing? How you doing? How you doing? It's like, well, what I'm doing, I'm trying to save my company. Can you, in the nicest way possible, can you leave me alone? Right?
Exactly. If you stop calling me, I can actually do my job. Right?
Exactly. And so we appreciate that. So what we've said is that we do want to check in our companies, but the way we're going to do it is we're going to make sure there's a value exchange. So how are you doing? Here's a survey of how everyone's doing. I mean, we have, how are you managing culture? Here's a survey that tells you best practices from 20 companies on how they're managing culture. Here's something where we don't have to ask you a question, but here's a best practices on work from home tips. Some people, especially the startups, are much more
flexible. Yeah. Because many of them are co-working spaces to begin with, but even that's an impact. It's still a shift from an office to a house. Yeah.
So we're trying to make sure that we're giving ideas and answers to our startups, and not requiring them to reply to everything.
Gotcha.
But just make sure that that we're there, that they know we're there to help. Is probably the biggest message we're sending.
Okay. You mentioned in there that many of your companies have other investors. And so I'm wondering if you've had conversations with other investors in the region or across the country, and kind of what's happening in the investment community, right? Because while entrepreneurs may not be thinking about that because they're thinking about survival, it's good to know if there's any kind of chatter happening on the investor side, because clearly that's going to have a much longer impact for other entrepreneurs.
Yeah, we've talked to some investors, if I can be diplomatically honest. There's still work to do to align our philosophical approaches to how we deal with this.
Gotcha. Well, that was my concern. So yes.
Yeah, and so often what we do when we get into board meetings or investor meetings, we hear the conversation, and part of it may be, hey, look, let's pull the founder aside and have a conversation with them. We think that we have a way that they can execute on a path out of this that's much more aligned with their worldview than maybe some of the advice they're hearing.
Gotcha. And some of that is probably because you, coming back to where we started, you have the competitive advantage of having 800 LPs who are individuals who have access to outstanding and real-time, or even slightly before real-time, market information, as opposed to a traditional venture capital fund who may have pension fund folks. And Lord knows that's a ripple effect of if they go out and the pension fund goes out, and it's just a vicious cycle of folks being negatively impacted. So something that I would say tease out for entrepreneurs is, if you have a VC, be mindful that the response is going to be different, somewhat triggered by just general investment thesis, but somewhat triggered by who their LPs are. And if you're in the process of raising, be mindful in these kind of turbulent economic times, which I hope will get better, but there's no one saying this is going to be resolved by the summer, because the markets take time, that be mindful of who your investors are in the venture capital firm has an impact. Yeah,
exactly, Melissa. And a lot of our LPs are successful business people, and we had these discussions during the capital raise, and we heard loud and clear. I don't want you putting entrepreneurs out of a business so I can get an extra 1% on my return, because that's me. I mean, they empathize with our startups, right? And so I have that support to make sure that as we go in and look at these, and this is the thing that I've always struggled with, and still struggle with venture capital, and it may be to my detriment. And I think it aligns with some of the conversations we're hearing. If I'm 100% VC, I'm making X number of bets, and a small percentage of those bets are going to play out. And it's very removed from how I feel like venture capital works. For me, I've made X number of great relationships. I care about every single one of those relationships, and I can't imagine just turning my back on those great relationships. I don't care how many there are. Like, I can't continue to fund people, but I can continue to help people or make it help people to guide them out or something. But it's not just a numbers game for us. And like I said, that may be to our detriment eventually, but to the extent we all have a choice of how we die, if I have to die treating people well, and then
we'll take it. We'll take it over here. I also think there's an element of karma. Right. So I think you're positioned well. But to that point, we do have entrepreneurs, right, who are starting a fundraise or in the midst of a fundraise. So unfortunately, we know not all venture capital firms are you, both in terms of seeing a Black man at the helm and running the show, and certainly not having access to as much patient or understandable capital. So what would you say to entrepreneurs who are about to do a raise or in the midst of a raise? Like, do they continue? Do they stop? Do they settle for less? What do you recommend right now?
Yeah, and so like if you remove Motley Fool out of it a little bit and you just talk about the overall environment, what I would say is that if you're in the process of raising, there's no need to stop, but you really need to do an assessment of how well your company is going to do in this current environment. If you're not positioned to grow in this environment, you're going to have a hard time raising capital, and that's just the reality of it. And so if that's your position, then you probably need to figure out plans on how to cut your expenses as much as possible to get through the storm. And I would say that there are multiple phases of even the storm. Where we're in now is kind of the initial wave. I think advice is probably obvious to everyone. in this initial wave, if you're not one of the few, if you're a company that directly benefits from low interest rates, you may be able to raise capital now. If you're in a business where you're part of the chain of providing essential services, you can raise capital now. I will just as an example, probably the best positioned company we have is a company we just invested in. They have software, and it really is a B2B software solution to allow banks to make small business loans.
Oh, wow.
All of you have heard the noise about the government and even some private companies putting money up to get it into the hands of small business owners. What they're not saying, and what we know, because really they actually don't have the mechanism to do that in any kind of structured way. This startup that we invested in, that is actually what they do. So they are incredibly well positioned now, and our biggest challenge is getting them in front of the people who are looking for this solution and doesn't know it exists. And they're probably going to need to raise capital to get to have the money to go after all the opportunities right in front of them. They won't have any problem. I mean, that's a story that tells itself on the news every single night. There are other companies that their business is critical on gathering people together. Think construction, or some other things. If a construction site goes dark, there's no construction going on, right?
Right.
They're gonna struggle to raise capital during this time. That's the thing. So be honest about where you are. And then the other thing is talk to your existing investors, and I think this will go in the second wave when things calm down a little bit. If your investors can clearly see that you are on a good trajectory and can point to the day where things fell through the roof, and they believe, like construction, construction is going to come back. Someone's not going to stop with a half-built office building, right? And things will return. You can tell a credible story to your existing investors to help fund you through it. And most of them are kind of open to those ideas. There may be some valuation pressures, depending on what that last round and what that promise was, but it's possible. But if your idea was opening a restaurant, you really got to figure out how to hunker down, or quite honestly, if we run into a situation where great idea, bad time, and then putting my Motley Fool hat back on, it becomes, okay, I hope no one is blaming themselves for the coronavirus. So I think this is an easy one. So this is not your fault.
Right.
But great idea, wrong time. How do we wind down in a way that preserves relationships, preserves contacts, so that for the next idea, we're best positioned to kind of deal with that.
So I just want to stay on this point a little bit in terms of fundraising. So if you're able to, you're telling folks to continue if they think they have a pathway forward, and recognizing some of the valuation pressure, would you then say, don't go for a price round, or would you say be willing to settle for less and sell less? Are there any strategies that entrepreneurs should be thinking about, just because the cost of capital is so high in general?
Yeah, the cost of capital is high, but unfortunately, like any kind of low cost capital is just unavailable. Going to your bank, well, they're closed anyway, but even if they were open, you're doing it because you like to see that person smile, but that's about all you're going to get out of them. So don't even. Yes, but I would say now, unfortunately, you're going to have to make some tough decisions as a founder. And like I said, outside of the Motley Fool, I would say this, but valuations are going to come down. You may have to be a little more open to dilution to get through this round. But it goes back to like the plan. First thing we do is have a plan. Put it down in paper, write it, think about it, make sure it's viable so that you're not raising. Now is not the time to raise too much money. I'm going to put it that way, because it's going to come at a cost that's really high. But I do think that put the plan together. Everyone in all of our portfolio companies doing this, even the ones that have sufficient capital, they're looking at their expenses and their costs and using this as a time to rationalize some of those down to become a little bit leaner. Everyone should be thinking about how they can get lean, but not so lean that they can't respond when opportunities come as things turn around.
You mentioned, and I'm tracking the chat, so if people have questions, please put them in there. You just made the comment, and I'm taking notes too, don't raise too much money. How would you define too much? Is that a dollar amount, or is that a overall percentage of, like, maybe you should think about 60% or 50% of what you were going to raise? Or are there some dollars where you feel like the risk tolerance hasn't changed from a VC perspective?
So it's so funny, and I will say this. I think it's a generalization, but it's actually, it's just data from my portfolio.
Mm-hmm.
Our female founders have bigger cash balances than our male founders. And
we are much more patient and methodical.
Yeah, and so like I have one founder who has 18 months of cash.
Wow.
And she's saying, you know what? I would love to raise a little bit more just to not be nervous. And I have some dudes, man, like April. I'm good till April. And I'm like, man, what are you doing? Just like,
that's 2 weeks from now, my friend. I think you need to think of plan C.
Right. Yeah. I need April what? Because that's in a week.
He was going to make it till tax time, and that was it.
April 1, because that's March. But this idea that you've all heard, raise 12 to 18 months of capital. But what we're finding is the companies that are best positioned are the ones that have 12 to 18 months of reserves. So it's not what you have the day after you raise, or what you have going into a raise. Tends to be a much more kind of prudent approach. So when you say don't raise too much money now, if you feel like you've put together a plan and you need $10 million to kind of get through this, and someone, and you want 10% of the company, and someone says, I'll give you 25 for 30 or something like that. I mean, that big cash cushion may feel great, but it's going to be really, really expensive. I mean, that's going to cover a wide range of scenarios. One thing I will say about capital raising, and I found this over and over and over again, is tough. The best tool you have for raising capital is operating your business well. Mm-hmm. And it's when you hear it, it's obvious, but it really works. There's nothing like running your business well that gets people excited about investing in it. And that's something that we all kind of have.
We're going to quote you on that one, man. We're going to quote you on that.
Yeah. And you could, and even in a downturn, how you handle a downturn says a lot about you. The people that come to us, hey, this is where we are. This is what my burn is. I have a plan to get it down to this. What else can we do? That's great. And this is something I learned from dealing with banks over the years. Make sure that when you go and ask people for money, that you are clear about what you are going to do also. I don't know, it's probably just implied, but people need to hear that you're asking them for help, not to solve your problems, right? So my burn is X. I'm going to cut my burn by 40%. And then if I can raise a little more capital to go with that, we're good. That's a story that starts a conversation. The story that I'm out in April, I need to raise some more money.
Right. Well, so let me ask you this. So this is obviously hypothetical, but if somebody in your portfolio, because this point around, which was I'm going to quote you, the best tool for raising money is running your business well. I want to be clear. I'm not implying that the person is not running their business well just because one has 18 months versus one, but that's a big difference, right? Of helping the business stay on their current momentum versus saving them. And so I'm just curious, less about your portfolio company, because there's probably some nuances there, but like, how is that going to look in this current climate that somebody has 18 months versus somebody has a couple of months, knowing the fundraising process takes a long time? How would you view a company like that coming in at this time? Because some folks are going to need it probably sooner than expected, particularly because of the cuts. And I'm just curious how you're going to take that into consideration.
Yeah, we do take it into consideration. And it's an interesting dynamic. And this is the schizophrenic nature of venture capital, where in good times, they're telling you, we're giving you the money to spend it, to grow. So get it and spend. And if you give someone money and they aren't spending it fast, it becomes a little bit disappointing. But now they're telling you, well, no, you should conserve cash. And it's schizophrenic, right? Yes. It is. And I think part of that is a moderation, right? If I've invested $1 million in you a year ago, and you don't have any revenue, and a year later you have 900,000.
Right.
My question to you is really is that, are you sure you want to be in the venture capital game? Because
Yep.
you're not really, you
Yep.
don't have plans that align with that. So it's a little bit of misalignment.
Sure.
But yeah, so I tell people, just be thoughtful of how it is. What I'm telling folks is make sure that they're using outsourced resources whenever they can. For all the bashing about WeWork, that's a good way
Sure.
to manage your long-term costs. Because what you don't want to do in this time period is be stuck trying to get out of a lot of fixed costs.
Yep.
No, and it's a difficult situation to be in, but there's things that we can help. And for us, it's the beauty of this is, if there's any beauty in this is a wonderful time to build relationships. It's a wonderful time to have substantive conversations. It's a wonderful time, for better or worse, to find out who your peeps are and who your peeps aren't, right?
Gotcha.
That's
true. Who's going to be standing with you? That's for sure.
Right.
In that vein, right? So you raised the question of like, is venture capital even right? Or appropriately aligned, I should say. Every day we're seeing debt from banks, SBA loans, although they do require a personal guarantee, but there's lots of bailout programs that are going to be coming down the pike from government and from the banks. What's your view in terms of that kind of money coming into your capital stack, and how should entrepreneurs be thinking about using that, or assessing its value to them?
Yeah, and I've seen some of those programs, and obviously they're highlights. Like I said, we've dug in a little bit and find that they fall apart at the execution level.
Yeah.
But philosophically, I don't think the country has ever done something like this for the small businesses. But some of the headlines are amazingly attractive. The 300 billion that was announced, if I understand it correctly, that's basically to keep small businesses from having to lay people off. And
Right.
what government understands is that layoffs and unemployments are the first domino in a recession. Right. So they can pay us now, they can pay us later.
Right. That's right. Somebody's going to pay. Somebody's
going to pay. And so they're setting that up to be really, really attractive, to cover your payroll for 4 months. And if you don't do any layoffs, that the entire loan is forgiven.
Yep.
And if you do, it does convert into a loan that has a little bit of a, and it has a rate on it, but it's not predatory, or even close to it. It's a very attractive rate. So I would say for now, get in line for every single penny you can, because I don't know how it's going to be doled out. I don't know what the details. You can always, it's a lot easier to get in line and go forward and then not sign the paperwork.
Gotcha. Yep.
At the time than it is to wait until you have all the answers and then get in the end of the line and find out by the time you get to the front, it's all gone.
So that's a good point, right? Because not that we have any new time, but it's a good way to use our time. Just to tease that out a bit, because there are grants out there and there are loans out there. And typically, if people are in the venture capital continuum, at some point in time, they could explore venture debt. At this point, because you're kind of looking at earlier companies of Series A, any reservations of companies taking on debt? So going from a Series A to a debt round, and then hoping a year, 18 months from now, they're back into the VC market?
No reservations on. We have quite a few folks that we talk to on venture debt. It doesn't come into play usually when we're doing our initial investment, but as our companies are growing, and getting a little bit better capitalized, they're getting into venture debt territory. And again, as a VC, venture debt is bad because I would rather them fund with equity because I make more money. But I think for founders, we always say it. As soon as venture debt is available, just because they understand it's so much cheaper than venture capital, that you really should do that. I'll get my return on the multiple of the savings that you get from going to venture debt, so I'll still get paid. I don't need to get it. I don't need to be first in line for every single line in the buffet.
That's fair.
I think we can make this work together. There's enough for everyone. But yeah, venture debt, what you're going to find very often is they like to participate along with the VC because they want that backstop. And the same thing with banks. They're looking for venture capital to be a backstop. And so it is a good approach for a lot of reasons if you can form a a syndicate. If you can say, hey, I'm doing this on the operations side. If there is venture debt available, that's great. And if there's venture capital to go with that, so that all of us can see that we're all in it together,
Yep.
that's probably the best way to get over that psychological hurdle. The toughest thing is asking one person to fund your way through this.
Gotcha.
It's just putting a lot of pressure on that person.
Gotcha. One thing we have been spending time on is kind of providing tactical information. So we've talked similar to you, don't panic, assess where you are, told people to take a look at their cash position, look at accounts payable and accounts receivable and see what you can do to extend the payable and accelerate the receivables. We've also people look at contracts. You've mentioned that, right? Particularly if you have corporate or supply chain relationships, making sure, we've learned through some other organization I'm on the board of that force majeure is a term that people never thought they would have to use, and what defines, allowable deference or avoidance of payment. But as people think about this, how do you feel about companies coming together? Obviously venture capital in particular is used to scale. And so if folks are thinking about joint venture agreements to kind of get some scale and get access to capital for supply chain, government procurement, how do you feel about joint ventures, and what are some things that people should be mindful of?
Yeah, I think that would be a great idea. And I would say my perspective on this is somewhat limited. I only have advice for people who are dealing with trusted partners who they want to have long-term relationships with. If you're at a point where you're scrambling to survive or you're dealing with sharks, that's not what these conversations are about.
Right.
But yeah, if you have relationships, this is where communication comes into play. I mean, if it's a strong relationship and it's really mutually beneficial,
yeah, that's key.
and they want you to survive and you want them to survive. Yep. Everyone sees what's going on. Nobody doesn't know what's going on. Right? Talk to them. Say, here to go. We're a little tight. Is there some way that we can make an arrangement where we can have an arrangement that just gets us through this one way or another? And that's the other thing I would say. We talk a little bit about negotiations, and we're putting things, something else together for our founders about it. In most negotiations, the parties don't want the same thing.
Right.
And in fact, they're solving each other's problems. So if you can go to them with the ideas, here's how I can help you, and here's how I need help. Sure. Often those things fit together. They're not this. It's not like we're not fighting over a pile of money in the middle. We're trying to come together to make a pile of money for us, right?
Right. That's right.
Right. So what can I do? Here's some things I think I can do to help your business right now. And I would say this is something that's also obvious once you say it, but big companies right now, those large partners, they don't need you to cut your fees. I mean, if you're getting, I'm just using them generic because you're dealing with Walmart. Walmart makes $1.5 billion a day.
Right.
You couldn't move the needle on their revenue if you wanted to.
Right.
And so offering to cut your prices isn't really, while it does something psychological. What you really can do is, what big companies don't like is uncertainty. So anything that you can do to take a little bit of uncertainty off of their plate is going to be just as valuable as dollars. If you can say to them, hey, I know this is a great initiative that we're working on together. I understand that things are being cut. How about if we do this? I can make sure that there's continuity through this initiative. We're going to continue to do this. We're going to do that. In exchange, can you do that? Is there some sort of equity investment you can make, or something strategic that helps me to finance this? And then you don't have to worry about us. You can go and worry about the other 999 problems you have.
Right.
But we aren't one.
One of them. I like that. I like that.
Yeah.
But it's also, because I teach, I talk to a lot of college students. I'm like, there's a difference between marriage of opportunity and marriage of necessity. Right. And it seems to me, if people are going to pursue joint ventures, to your point, it's going to sound obvious, but the normal things around making sure there's an out clause, making sure there's clarity around decision-making, making sure there's clarity around investment, making sure there's clarity around how do you get money out, all those things. But I think the decision-making is probably the biggest, will remain. We have time, we have questions coming in. So I'm going to ask this one question, and I'm not sure if you're familiar with them, but EB5, I don't know if you do anything with EB5.
I'm generally familiar with the program, which has people coming in for investment, coming
Yep.
into U.S. for an early visa. I don't have, we don't deal with any of those in our portfolios,
Okay.
and I don't have a lot of information
Okay.
about
And
that.
I have to admit, I don't have a lot of insight, so I'm sorry, LaSonia, I don't have a lot of insight on the EB5 visa investors. I think some of that is probably at this level going to pan out at what's the federal policies around that. And I think generally, I know particularly in the DC area, there's a lot of EB5 in real estate. And to your point, I think it's going to be, I don't know that that's going to be money to solve the slump, but I know there's already a lot here, so we should be good.
Yeah.
I want to see if there's any last minute comments you want to make, because I want to respect your time, and I know you are managing a lot of people who are counting on you, both on the 800 LPs and the portfolio companies. Any last minute words of wisdom for folks?
What I would say for folks is to really be disciplined through this process. Again, think about it. A lot of the people that you need to help, that you need their help to get through this, will benefit from your discipline. Be clear about where you are. Be clear about where you need to go. Be clear about what you need to get to that point. And what I will say is, while I typically at this point would say, if any of you have questions, kind of reach out to me, but that's as much as my heart is saying that, my mind is telling me it's not going to work right now.
Right. Well, I get it.
I get a little bit, but what I would promise to all of you is that I will stay in touch with Melissa.
Yep.
We will continue this dialogue, and to the extent that we're providing information to our portfolio companies that we feel comfortable sharing broadly. Some of it gets very detailed and is not appropriate.
Of course.
A lot of it is can be shared more broadly. I will make sure that Melissa is getting that information. And Melissa, if you ever want to get together, do
Absolutely.
this again.
As soon as this quarantine is over, I'm even willing to come to Virginia. I'm just getting stir crazy, so I'm happy to cross the bridge at this point. I appreciate that.
Well, no one's in Virginia right now. We shut our offices down through May.
Oh, there you go.
Through May 1st, yeah.
There you go. May 1st. Okay, well, that's the signal, May 1st. So I want to thank you, Olin, because you have always been there for us. And I would say, I know that you are an invaluable resource to 1863. So if folks have questions, you can always reach out to us at 1863. Some key things that I want to say are: be disciplined, don't panic, but plan. Communicate and make sure through all this. I think my biggest takeaway, Olin, is sustain relationships, right? Because that's going to last longer than any investment that any of us are going to have. So I just want to, again, on behalf of 1863, say thank you. You took the call as soon as I emailed you. You didn't even know what you were signing up for. And that's a lot about you in particular. And so we are grateful for you and your presence in this ecosystem and community, and grateful to all the work that you're doing at Motley Fool. So enjoy the weekend to the extent that you can. We'll be prayers up for you and for your portfolio companies and for your family. And just thank you for all that you do for us. We appreciate you, man.
All right. Thank you very much. It was a pleasure doing this.
Thank you, man. Take it easy.
All
and
right.
thank you all for watching.